Hey, welcome back. I want to tell you about the most expensive lesson I learned building quantitative trading systems that manage eight figures in capital. A backtest showing a 90% win rate and a beautiful equity curve means almost nothing about how that strategy will perform in live markets. I know how painful that sounds if you just spent weeks building a strategy that looks perfect on historical data. Every serious quant has been there. You build something, you backtest it, the results look incredible. You feel like you found the holy grail. Then you go live, and the strategy performs nothing like the backtest predicted. Sometimes it loses immediately. Sometimes it works for a while and then collapses. You are left confused, wondering what went wrong with something that looked mathematically perfect. Here is the truth most retail traders never learn. Backtests do not lie because the math is wrong. They lie because of specific, predictable biases that creep into almost every backtesting process. Once you understand exactly where these biases come from, you can build backtests that actually predict live performance instead of fooling you into false confidence. Today, I am breaking down exactly why your backtest is lying to you and what to do about it. Let us get into it. Overfitting, the silent killer of strategies. The single biggest reason backtests lie is overfitting. It is responsible for more failed live trading strategies than every other factor combined. Here is what overfitting actually is. When you build a trading strategy, you test it against historical data. If you adjust your parameters enough times, testing different moving average lengths, RSI thresholds, stop loss percentages, and entry conditions, you will eventually find a combination that produces an excellent result on that specific historical data set. But you did not discover a genuine market pattern. You discovered a combination of numbers that happened to fit the noise in that particular historical period perfectly. Think of it this way. If you flip a coin 1000 times and then go back and find a pattern in when it landed heads versus tails, you can construct a rule that perfectly explains that specific sequence. But that rule has no predictive power for the next flip because the original sequence was random. You just found a complex way to describe noise. This is exactly what happens when traders optimize a strategy extensively against historical price data. With enough parameters and enough adjustment, you can almost always find a combination that produces a beautiful backtest. But you have not found a real market edge. You have found a description of historical noise with zero predictive power going forward. Professional quants have a rule for this. If your strategy has more than 3 to 5 core parameters, be deeply suspicious of any backtest result, no matter how impressive it looks. Simple strategies with few parameters that perform reasonably well across many different market conditions are far more trustworthy than complex strategies with dozens of optimized parameters that perform spectacularly on one specific historical period. Look ahead bias, using information you would not have had. The second major source of backtest lies is called look-ahead bias. It is sneakier than overfitting because it can hide inside backtesting code without the strategy builder even realizing it. Look-ahead bias occurs when your backtest accidentally uses information that would not have actually been available at the moment the trading decision was supposedly being made. Here is a common example. Imagine you are backtesting a strategy that uses the daily closing price to generate signals. If your code calculates the signal using the full day's candle, including the close, and then assumes you could enter at that same closing price, you have just given your strategy perfect knowledge of where the day would close before the day actually ended. In live trading, you would never have that information until after the candle closed. Another common example involves data that gets revised after the fact. Certain on-chain metrics and some exchange data points are sometimes corrected after initial publication. If your backtest uses the final corrected data, But in live trading, you would have only had access to the initial, less accurate data. Your backtest is testing against information you would not have actually had. A third version involves survivorship in your dataset. If you are backtesting across a basket of cryptocurrencies and your data only includes coins that still exist today, you have eliminated every project that failed or was delisted. Your backtest looks artificially strong because it never had to suffer through holding a coin that went to zero, even though that risk was very real at the time. Look ahead bias is dangerous because the results look completely legitimate. There is no obvious red flag. The strategy simply performs in a way that is structurally impossible in live trading because it is using future information relative to each decision point. Survivorship bias in your dataset. Survivorship bias deserves its own explanation because it specifically and severely distorts crypto backtesting. The crypto market has an enormous graveyard of failed projects. Thousands of cryptocurrencies that existed at some point and no longer trade meaningfully. Exchanges that shut down, tokens delisted after collapsing to near zero. Most readily available historical crypto datasets only contain assets still actively trading today. This creates a severe distortion in any backtest that tests a strategy across multiple coins. Here is why this matters so much. If you backtest a momentum strategy that buys coins showing strong recent price increases, and your dataset only includes coins that survive to the present day, your backtest is systematically biased toward survivors. The coins that pumped hard and then completely collapsed, the ones that would have severely damaged your strategy's actual performance, are simply missing from your dataset because they no longer exist to be tracked. Your backtest shows you profiting from the winners while never showing you the catastrophic losses from buying momentum in projects that later turned out to be failures or scams. This bias is particularly severe in crypto compared to traditional markets because the failure rate of individual crypto projects is dramatically higher than publicly traded stocks on major exchanges. The solution requires deliberately sourcing historical datasets that include delisted and failed projects, which is genuinely difficult and often requires paid specialized data providers. If you cannot verify that your dataset includes failed and delisted assets, significantly discount any backtest results from a strategy that trades across multiple altcoins. Transient costs and slippage assumptions. The fourth major source of backtest lies sounds boring, but has an enormous practical impact. Unrealistic assumptions about transaction costs and slippage. Slippage is the difference between the price you expected on a trade and the price you actually received. It happens because the market moves between when you decide to trade and when your order executes. And because large orders can move price against you as they fill. Most basic backtests assume you execute every trade at the exact candle price with zero slippage and minimal fees. This assumption is almost never realistic in live trading conditions. Here is why this matters so much for strategies popular with retail traders. High frequency strategies that take many trades per day or week are devastated by realistic transaction cost assumptions. A strategy that looks profitable assuming zero slippage and minimal fees can become a guaranteed loser once you account for the real bid-ask spread, the real exchange fees on every entry and exit, and the realistic slippage that occurs especially during volatile conditions or when trading less liquid altcoins. This effect compounds dramatically with trade frequency. A strategy taking one trade per month can absorb realistic costs without much impact on profitability. A strategy taking 10 trades per day can have its entire theoretical edge completely consumed by costs that were never properly modeled. Professional quants build backtests using conservative, realistic transaction cost assumptions specific to the actual market and asset being traded. This means using realistic spread estimates for the specific coin and exchange, modeling slippage that increases during high volatility, and including all actual exchange fees rather than promotional tiers that may not reflect your real trading costs. If your backtest does not explicitly model realistic costs for your specific trading frequency, you are looking at a fictional version of your strategy's performance. Regime change: why the past does not repeat exactly. The fifth major reason backtests lie is more philosophical but equally important. Markets change their underlying character over time, a phenomenon professionals call regime change. A strategy can be genuinely free of overfitting, look-ahead bias, survivorship bias, and unrealistic cost assumptions, and still fail in live trading because the market regime it was built and tested on no longer exists. Crypto markets have moved through dramatically different regimes, periods of extremely high retail participation and extreme volatility, periods of increasing institutional dominance and relatively lower volatility, periods where correlation between different crypto assets was very high, meaning everything moved together, periods where that correlation broke down significantly. A strategy built during a high retail, high volatility regime may perform completely differently once institutional participation increases and market structure fundamentally shifts. This is not something you can fully eliminate through better backtesting technique. It is an inherent characteristic of markets that are constantly evolving. The professional approach is twofold. Test your strategy across multiple distinct historical regimes, not just one favorable period, and build in ongoing monitoring of live performance against backtested expectations, with predetermined rules for reducing position size or pausing the strategy entirely if live performance diverges significantly for an extended period. No backtest, no matter how carefully constructed, can guarantee future performance. The goal is not certainty, it is reducing the probability that you are fooling yourself. Let me bring everything together. Your backtest lies to you for 5 reasons. Overfitting. Too many adjusted parameters fit your strategy perfectly to historical noise rather than discovering a genuine repeatable edge. Look ahead bias. Your backtest accidentally uses information that would not have actually been available at the moment each decision was made. Survivorship bias. Your dataset only includes assets that still exist today, hiding the catastrophic losses from projects that failed. Unrealistic transaction costs. Real fees and slippage can destroy a strategy's theoretical edge, especially at high trade frequency. Regime change. Markets evolve, and a strategy optimized for one market character may fail when that character shifts. Here is what I want you to take away. A backtest is not proof that a strategy works. It is evidence with significant limitations that needs critical evaluation rather than blind trust. The traders who build genuinely robust systems are not the ones with the highest backtest returns. They are the ones deeply skeptical of their own backtests, who actively hunt for these biases in their own work, and who test across multiple market regimes before risking real capital. Build simple strategies with few parameters. Source clean data that includes failed assets. Model realistic transaction costs. Test across multiple regimes, and always trade small initially to confirm live performance reasonably matches expectations before scaling up. The gap between a beautiful backtest and consistent live profitability is where most trading careers actually live or die. Understanding these 5 biases is the first step toward closing that gap. If this video gave you genuine clarity on why backtests fail in live markets, please hit the like button and subscribe. This is knowledge that took real capital and real losses to learn, and I am giving it to you for free. Drop a comment below and tell me this. Has a strategy ever looked perfect in backtesting and then failed in live trading? What happened? I read every comment. I will see you in the next one. Trade safe.